Hey listeners, I just had on Michael Repetný, CEO of Marinade Labs. Marinade is one of the biggest players in the Solana staking space, and even though they've been around since near the beginning, we are yet to have Marinade on Lightspeed, so this was a long overdue conversation. We talk about how to build a successful staking business, Marinade's origin, and why Michael is less bullish on liquid staking than on native staking, among other things. It's a really fun conversation, so let's get into it. This episode is brought to you by Katana, a DeFi-first chain built for deep liquidity and high yield. You'll be hearing more from them later in the show. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubinek, joined today by Michael Repetný, the CEO of Marinade Labs, one of the real core, largest staking infrastructure providers on Solana. Glad to have you on the show today, Michael. Thanks for joining us.
Thanks, Zane. Thanks for having me. It's a pleasure.
I don't always start with the origin story question because it can be a little lazy, but I was looking through some of your old posts preparing for this episode, and I knew the story that Marinade sort of came from an early Solana hackathon rather than maybe the traditional raise venture funding route. But I saw you writing about how there was some co-founder drama at the very beginning, and funds went to your Serum wallet instead of your co-founders, and there was a split and so forth. So I kind of wanted to ask you about the early days of Marinade, maybe specifically about this co-founder split or whatever it was that happened, because that was not a piece that I've heard you speak about in past podcasts.
Right. Yeah. Let's do it. Let's get to it. So this was late 2020. So right after my looking into, I experienced the Ethereum DeFi back in 2020. Loved the concept. Play with the DeFi there up until to a point where it just got so expensive to participate. So I need to set alarm clock at 4 a.m. in the morning for the gas fees to be low enough to do anything. And then I started looking at Polkadot, at Kusama, so some other chains that looked really great on paper, should be cheap and should be fast, but it was just not in production yet. And then late 2020, I could call it a Discord friend of mine, actually out of Slovakia too, as we were talking with Jack, that he's originally out of Slovakia. So this was a Slovak guy, and I was looking for a gig in crypto. As before, I was running a web analytics company in the Web2 space. Then I was doing consulting through the conversion rate optimization in the e-commerce space. And then 2020, I participated in a bunch of hackathons, and I wanted to do more. I was keen on trying to understand what crypto is about technologically, not only getting rich super quick, because that didn't work out well. And then I found this guy on Discord, and he told me, look, we have a team. We want to do something on Solana. Let's join us. So I would join them, and then found out there was no team. There was this guy alone because the team kind of left him. They participated in ETH Denver, if I'm not mistaken, before, with a similar concept, trying to do liquid staking for some work protocols back then. And then I joined him, and then me and him started to look for more people, again, on Discord, to join us for this crazy hackathon running on Solana. And I knew nothing about Solana at that time, but he had me sign up. We signed up for it and started to build what I knew from the other chains, which was the concept of liquid staking, which was non-existent on Solana back then, but I knew the concept as a user coming from the other chains where it felt great. You could be both staking, get a staking yield, and at the same time participate in DeFi. So I felt like, okay, this is a great hackathon project. Let's build this. Let's spend 2 weeks on it and then move on with our lives, most likely. And we started building. So that was the very start of it. After the hackathon, we got awarded some prize, and that's where there were some, I would say, discussions between me and him, just different ways, how we saw where to go forward. Some of his ex-team members also joined after the success in hackathon, and they were like, oh, you are like stealing our name. We want to join you now, and we don't want you to build on Solana, though. We want you to do other chains. So that was the moment when I realized I want something else. He wanted something else. And we let the team vote pretty much. And the team decided to go, at that time to go with me. So we were lucky to get a grant from Solana and Serum Foundation back then, which was $80,000. So we had the runway for the next 6-7 months with some people that we got on board. We paid nothing to ourselves initially. And that was really the origins of Marinade. We rejected all the VC money and started building, hoping that maybe this underdog can beat the giant coming from ETH, Lido and all the rest that had the playbook. They knew how to do it. They also wanted to acquire us. So those were the very Wild West origins of Marinade from the very start.
Yeah, and I appreciate the Slovakia call out there. For those of you who listen to every Lightspeed episode, you'll know this is the second straight episode that we've had a Slavic guest. So we just had Victor, who's Slovak, and Michael, I guess you're Czech. So you can come to the barbecue. We're all neighbors. But good shout out there. Slovakia stays winning. But yeah, you also said there was some like call with the Serum team, which for those who are unfamiliar, Serum, early Solana DEX, sort of incubated by FTX. And they agreed to give you this grant, and you gave them your wallet address instead of the co-founder's address, and then the co-founder was upset, and that's kind of how the final nail in the coffin happened, so to speak.
Yeah, so that was at the time when the team like already decided to go with me leading forward, and we were both on the call, and so both of us representing the team of. At that time, it was called a different way. So we then rebranded it to Marinade after that hackathon, actually, because like of some confusion and some other team members coming back to life. And that was the moment where we needed to act. We need to do something. So we realized we need to act fast, and pretty much agreed with the guy from the Serum Foundation to send the grant to this destination wallet, which we, in all transparency, then spend on the resources and people at Marinade at the very start. And I wouldn't see anything of it for the next 6 months, just trying to live off what we had in the past. But yeah, that was it. We were like the speedy ones. I wouldn't call it super upset. It was the result of the team at that time. So we actually made it clear, and the guy left on a good way. So we can still talk to each other. He ended up working on Ethereum. So I wouldn't call it extreme friends, obviously, but it is what it is. We move on, and after that, we actually we merged with another hackathon project called Smart Pool at that time. So after the hackathon was done, we were just a bunch of 3-4 people maybe at that time. So we were looking for more. And I started and I DM'd every single participant of that hackathon via Discord, asking them, okay, what are you going to do now? And a few guys came back to me, and one of them was Lucio out of Smart Pool, which was pretty much the competition and doing the same thing like we were at Marinade. So we started talking, and then it was him and Marco Broken, now the co-founder of Triton, that ended up founding, so to say, the very initial core contributors team of Marinade by merging the two code bases together out of the hackathon.
Oh, I didn't know Triton was involved in this. That's interesting. They're one of the Solana RPC providers.
Yeah, and Marco wasn't even in Triton, because Triton did not exist when we started Marinade. So it was, I think, 3-4 months in us building Marinade when Marco decided to step down and join or co-found Triton, actually.
Okay, so all of this happens. You create a Solana liquid staking token, your own token, and so forth. And then I thought it was interesting. Was it this spring or maybe last fall? You all went through the Solana startup incubator, even though you had kind of been around in Solana terms for a while. So I was curious what led to that decision to go through the incubator and whether it was helpful.
Yeah, so this was an interesting decision. We don't regret it at all, even if us running 2-3 years already Marinade, why would we join an incubator? I think there are two main reasons why. One was that most of the Marinade contributors would be based out of Europe, while most of the business is, and especially post-election, is made out there in the US. So we just felt this gap, to tell the truth, that we are not there. We are not close to the Solana ecosystem overall. So that was one of the reasons why we moved there to New York for 3 months through the incubator. And the other one is that the whole institutional part of Marinade was truly something that we started to incubate, if you will, because MSOL, the first liquid staking token out there on Solana, has been there for a while. And people know especially that part. But about a year ago, we started on this journey towards institutional and trying to make sure that Marinade is safe and secure also for institutions. So that was a great timing for us, especially again in this with this new administration, to move to New York and to get as much as feedback as we could. And that's truly what we got. So like Imon and all the team at Solana were super helpful, just arranging a bunch of meetings with all the ecosystem players, the funds, the family offices, you name it. And they were just lined up to us in the office. We got to talk to them and got a bunch of feedback. And it's also thanks to this where Marinade it is today. So super helpful for that. And what I would recommend it to anyone, even someone advanced thinking that they are advanced.
Katana is an L2 built for DeFi, and it's pioneering the ecosystem category of productive TVL, believing that change should be graded on how efficiently assets are put to work in DeFi, rather than just total value locked. In just a couple months, Katana has surpassed $500 million in TVL, with over 90% of that TVL being productive in ecosystem on apps like Sushi and Morpho, which also receive boosted yields from Katana's unique Vault Bridge design. From now until the end of November, users that bridge to Katana can earn boosted yield from CAT incentive campaigns, added Vault Bridge yield, and other chain revenue. Major app launches will be coming down the pipeline in the next few months, with incentive campaigns for the Kensei Memecoin Launchpad and PerpStex partners for Katana. With the launch of Katana's chain-wide V tokenomics model, VCAT holders will be at the middle of the Katana flywheel, directing emissions and earning fees for their votes from partner protocols. Thanks, Katana, for making this episode possible. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. So, speaking of that institutional point, I would think that at this point in time, the whole ball game, the whole enchilada, if you will, for a Solana staking company is appealing to institutional investors. Like that is where the growth ahead lies, I would think, for Solana staking. I'm curious, as you've gone down this road a bit towards trying to build out a more institutional user base, like how is there any insight on how to build that kind of business where institutions want to use your staking infrastructure as opposed to others?
Yeah, so there were many learnings really on that journey I can share, because as we came out of as an originally DeFi protocol pretty much for retail, you would click stake Solana and it would be staked for the best yield out there through the Marinade web app. That's how it was. And then you got that MSOL and started using it in DeFi. That's how Marinade was known at the very start of it. We saw some growth. We saw from 0 to 6 million SOL TVL in a few months at the very start. And then the TVL stalled for quite some time. So we asked ourselves, why is that? Why people are not using liquid staking tokens? At that time, it was the adoption might be 4 or 5% of staked Solana would be in liquid staking tokens. Pretty much that was Marinade and Lido at that time. And we got great answers. We got that, look, there is a smart contract risk. There is delegation built already in the protocol. I can click a button and I delegate my Solana as little as 1 SOL to any of those 1,000 running validators. So I don't need to do it myself. And there are up to 2 days, the cooldown period. It's not that bad. So we got great answers why people wouldn't want to go through the smart contract risk and enter MSOL. And that's why 2 years ago, Marinade introduced a second product called Marinade Native. It's completely eliminating the smart contract risk. So the Marinade Native just sits on top of classic Solana staking in the sense that it only diversifies staking to multiple validators, but at no point can touch the underlying Solana because there is separation of powers. Pretty much the withdrawal authority stays on you. The stake authority is appointed to the Marinade system. So, and this was our aha moment, because from that moment, we were like, okay, so even without the smart contract risk, we get to help Solana to make it more safe, secure, robust, decentralized. That's awesome. Helping people in one click to stake to 100 plus ecosystem validators without the smart contract risk. So this was great. So, and the product grew from 0 to 1 million SOL in TVL in a bunch of weeks. And then again, we realized, okay, this is a completely new audience. The people using native staking, it's not everyday Joe user that would connect their wallet to the Marinade web app and would self-custody their Solana. They are using, most likely those are institutions using some qualified custody solutions. There is a different way how you talk to them, how you sell them. The whole process is super long. So starting from distribution, they could not, even if they wanted, the institutions could not stake with this Marinade native product a year ago because we were not integrated anywhere in the ecosystem. So that was something we needed to work on. I think the whole team a year ago joined us, Hadley Stern, ex-Fidelity at ex-BNYM, a TradFi veteran, if you will, that helped us identify many gaps on just compliance, the product, how we stood up the team pretty much, legal side of it. So we needed to remove all those gaps, went through SOC 2 audit. So there's a bunch of things to it. I would say TLDR is, it's very relationship. It's very long-term cycle to do these things. And it's very, very different from what we were used to in retail, where it's pretty much self-service. People come, they stake, and they serve themselves. Right now, it's heavy due diligence. It's historic performance. It's making sure that you check all the boxes to at least be considered a viable option along, again, the multi-chain node operators that are usually the ones that they are picking.
Does the native staking product take commission?
Yeah, so good question. So at the very origin, people were like, what are they doing at Marinade? There is no way to take cut on it because there is just no custody of that SOL. So we saw that too, and eventually build up a mechanics where the validators pretty much, they put up a deposit. So they put up a bond. We call it protected staking rewards bond, which serves like an insurance, if you will, to make sure that they are going to deliver on their performance. If there is downtime or commission changes, then this is protecting the staking rewards. And out of this bond, the validators can share additional upside back with the stakers. So we came up with a way, call it stake auction marketplace, for the validators to make sure that this upside is shared back to stakers through this open market. And this is how Marinade system takes cut today. So the way it works is that the validators are bidding for stake. And then for the bids flow, that's where Marinade takes a cut, and the rest of it gets shared to stakers, which is how Marinade provides the best yield on the market.
Gotcha. Because that was my question, was that I was wondering if from a revenue perspective, it would be preferable for people to liquid stake, because I guess with the stake pool, there's more opportunities.
It's the same. So the MSOL has now 0 performance fee. So there is no performance fee. There used to be performance fee on MSOL when Marinade launched the stake auction marketplace, and the way to start charging the validators, not the stakers. That was the moment we set MSOL fees to 0%. And so right now, it doesn't matter from which product the TVL comes, be it the liquid staking or the native staking product. The validators pretty much fight for the same pool of SOL to be delegated to them.
And then from your perspective, it doesn't, both are equally lucrative to your business?
So look, from business perspective, if I'm looking at Solana staking market overall, we see 10% of Solana being staked through liquid staking tokens. And it's not only MSOL, it's tens, if not hundreds of other LSDs right now. So the whole liquid staking space got extremely crowded, and it's sitting at 10%. I mean, it is growing mainly because of those exchanges starting to participate and launch their own LSDs. At the same time, we see the numbers that 90% of people still, or of SOL, still prefer to be staked via native staking without any smart contract risk. So if you ask me today, this 10.5 million Solana TVL in Marinade, it's split half and half between liquid staking MSOL and native staking. And we feel like there is much more potential, much more opportunity on the native staking front, just because of that's what market tells us. And that's where we feel like that's where we're heading.
Yeah, it's interesting. Like, liquid staking makes more sense. I think like objectively, it's probably better to liquid stake than native stake. I mean, I guess it depends how much you fear the smart contract risk that comes with buying liquid staking tokens. But I do think there is a like an irrational psychological bias to where buying Sol and then staking it and seeing these rewards come into your account versus having essentially a tokenized version of staked Sol where you don't actually see the yield in as clear of a way if you hold some of these liquid staking tokens. I think that matters more than you might think.
Yeah. I mean, it's very easy, right, to get through a token to get access to staked Solana. I agree. Like the UX of it, it's awesome. You go on Coinbase and buy MSOL, and boom, you are staking your Solana at 8% APY per year, which is awesome. At the same time, especially for institutions, it's not only about that. It's also about, okay, even besides the smart contract risk, some of them might look at it as pooling of assets. So you have like unknown other participants in it, and you all pool those assets together. You have compliance issues. You don't know which validators get that stake in the end. You don't know them. You don't know if they are in the right jurisdictions, right countries, if they are so compliant. Who are they? So you have a bunch of the tax triggers too, right? That in some jurisdictions, it's considered Sol to LSD to be a tax trigger too, while native staking is not. So there were just many things that we heard from especially the institutional market that made us realize that there are just so many hurdles for the sake of being liquid, which is not going to be even the advantage anymore. We think that just the case for LSDs on Solana is not as big as on other chains. I was always saying on Ethereum, even before there was Lido, there was no way people could participate in staking unless they had exactly 32 ETH and knew how to spin up the node. On Solana, again, you can click and you stake to any of those 1,000 validators. So it's just a different use case. And that got us thinking, okay, with Marinade, we are going to maximize rewards and minimize risk. And that's what we've been doing for the past years, trying to make sure we eliminate all the risks. We are as safe, if not safer, than staking to one of those big validators out there because we diversify, there is on-chain SLAs, all those things. And at the same time, we maximize the rewards. So if you compare Marinade to those other providers, most often, you would see that the yield is higher. So those are the two optics, almost like the IBRL equivalent to Solana. Those are the two optics we are trying to optimize at Marinade.
But to maybe steelman LSTs a bit, I mean, the benefit of them is that you have a token that's liquid and that you can go, lend out in DeFi or secure additional yield somehow. So there truly is a benefit that you don't get from native staking to LSTs. And I think it's an interesting, a really interesting thing to point out that you said like 10% of Solana stake is native. I think that's up from like 6%.
LSTs. 10% are in liquid staking.
Yes.
Okay.
That number was like 6%, I think, a year or two ago. So it just isn't increasing that much relative to what you might expect.
So, and I think, again, I love LSDs. There is still MSOL out there, and it makes like 50% of the Marinade's TVL. I just think it's fair to call out the trade-offs. And what we've seen 2 years ago is that most MSOL and even today most LSDs are not even used in DeFi. If you look at on chain, majority of LSDs are just truly held on wallets. So that begs the question, why is that, right? So people prefer, I guess, this immediate liquidity. In some jurisdictions, it's like preferential for tax reasons. So we all see that. Just if people just holding it for the sake of diversifying stake, or having the best yield, those are not the great reasons anymore. And that's why we built Marinade native. And that's why we also saw that some people stopped using MSOL or other LSDs at that time and started to use Marinade native instead. Because all they wanted out of it, what was their job to be done, was just to stake for the best rewards in the most secure way possible. And if there is a better way than LSDs, they are going to use it if it's accessible.
Fascinating. Okay, to dive a bit more into the stake auction marketplace, that came out 2024 some point, right?
Yeah, summer 24. Yeah.
from what I remember, one of the obstacles with it involved like sandwich attacking, basically, where the most profitable validators that were able to bid and win the stake may have also been sandwich attacking users. And I think that's something over time that you've taken steps to prevent in various ways. But I'm curious, like, is that the right story, first of all? And secondly, like, what is your sort of protocol with sandwich attacking? And before we dive into that, for users who are unfamiliar, sandwich attacking is basically when transactions get leaked so that a validator can place a trade both before and after a user to give them a worse price and pocket the difference. So it's bad for users, essentially.
Right. Yeah, super interesting topic, right? A year ago, Marinade introduced Stake Auction Marketplace, pretty much for the reason that the validators at that time and even today, they could share inflation rewards, they could share MEV rewards, and that's it. So as a staker, you had no visibility into how much of value actually the validator captures out of your staked Solana. And at some point, the priority fees that are 100% captured on the validator, they were equivalent to 1 to 2% annualized yield on the staking rewards. So as a staker, you were missing on 1 to 2% staking rewards, and you were just not aware because no one was really talking about it. This was just captured by the validators. So we asked ourselves, okay, if there are so many different benefits to stake beyond inflation, beyond MEV, like priority fees or stake-weighted QoS, this access to transactions, maybe governance, maybe reputation, because that's why validators set 0% commissions to attract stake in the first place and to rank higher when people look at their rankings. So we ask ourselves, okay, how this could be manifested through one single metric. And we were thinking, okay, there is no tooling really for them. So let's figure it out. Let's put it on the market to decide, because only the biggest validators and the biggest takers were able to do off-chain deals where they would do a contract and the big staker, the big whale, would get way better rate, way lower commission than the public, the retail. And we were like, okay, this is not cool. Let's do something about it. So Marinade launched a Stake Auction Marketplace, in a sense, allowing validators to stake any optional upside to share back with stakers through the system. So they are bidding. All the validators receiving stake from Marinade are bidding each other. And by the bid, they said how much they are willing to pay for each 1,000 stakes sold to them. And then the system looks around and decides how to allocate Solana to them to make it most profitable for the stakers again. That's the whole idea of the market after all. So we launched this and initially observing the situation, and validators hated it, right? Because for the first time ever, it was exposed pretty much how much of the priority fees were resulted in the yield captured previously on the validators, but exposed other things, just other benefits to stake. And the Marinade's APY, because of this auction and bidding, went through the roof. And then as we moved on, as you rightly say, because it's an open and permissionless system, and at least that's how the Marinade native started, now it's a bit different story. We saw that really anyone, as long as they had the bond, the deposit in the system, they could participate in the auction. So it was impossible for us to tell who is just losing money and who is doing something malicious. And then that's why they have this profit and that's why they can outbid everyone else. We just didn't know. And it was all new to us. And it was kind of interesting to see, while until I think January or Q1 25, with the help of the Ghost team, like the Sandwich.me team, and some other researchers in the space, we started to get some data. So there was some tooling around identifying, okay, who's malicious, who's not. Because it's also very hazy labeling, all this sandwiching and MEV. So for the whole time, we were thinking the market's going to figure it out. We were in touch in Triton, we were in touch with dApps. They were trying to build some blockers so that those transactions, they will not get to the malicious nodes, to the malicious validators. And we were thinking, okay, the network's got to sort it out. It's not on the market, like the Marinade trying to like blocklist and find the wrong actors. It should be sorted in the protocol itself. It should be impossible or there should be enough social capital or ways how to do it that those malicious actors will not get access to those transactions. So unfortunately, this didn't happen. I mean, we have multiple concurrent producers. We have some other ideas reducing block time, which is going to help. But those are like longer time horizons. So at some point with the tooling, we realized that there are many malicious actors participating in the auction, just like they were participating in other stake pools or even in the foundation program, to tell the truth. And at some point, it got that bad that we ran a DAO governance proposal, pretty much asking the community to start blocklisting those malicious actors that are malicious beyond doubt based on the data. And that's what the Marinade system did. So I think there are 2 or 3 occasions where tens of validators from the system got kicked out. And there were also one epoch where around 6 million Solana was restaked to another validators, to ones that are not running those malicious things. And no staker would feel it because the previous validators would pay for the redelegation out of the bond that they had with Marinade. So those were some learnings alongside it. I mean, we meant well, we observed, but I think that we needed to adapt with the system. And it is also why in April this year, Marinade launched a product called Marinade Select, which is now only open to KYC and verified validators. So Marinade Select is now a product with more than 30 validators you can stake to through Marinade, knowing that your stake goes to the validators that have been around for years. Those are the ones that would never ever try to do any malicious MEV attacks. And those are the reputable ones. So that's also our reaction to it. So yeah, that was kind of the story of Stake Auction Marketplace.
How big of a deal today is sandwiching, just from what you're seeing? Because I feel like, a year ago, and especially like summer of 2024, this was a big conversation. The Solana Foundation kicked a bunch of people out of the stake delegation program that were sandwichers. Jito did like a blacklisting thing as well. And we were talking about it a lot, and it just feels like it's not as much of a talking point anymore. And I don't know if that's because the problem has gone away or if just all the media and the crypto Twitter, talking heads have moved on. We did have Max Resnick came on the show a couple months ago from Anza and made the case that because Solana works more efficiently on a technical level, people aren't leaking their transactions as much because you don't need to just like spray your transaction to a bunch of validators to try to get it included in a block. So that's maybe one answer. But what are you seeing? How deal is sandwiching today?
Well, to tell the truth, we are not seeing much. As of the data tells us, there is not much to see right now, which is kind of sad because there was so much research into trying to understand and label the malicious from the not malicious validators. And also we were about to rely heavily with the Marinade's delegation strategy on those systems that could tell almost beyond doubt, I would say, the wrong from the good guys. It's just that right now it's a cat and mouse game. That's what we said even the last year. You come up with methodology to identify the bad guys adapt, and then it's like you chase it around and around. So right now the tooling, it shows, I think, less than 5 sandwiching validators, and it shows as all went away. So that's what the tooling tells us. I think where the truth is, and I'm not that deep as a researcher in it, but I think that the truth is as they all kind of adapted. They use more sophisticated ways of doing those attacks. And at the same time, I would agree to what Max said. The whole REV on Solana, like quarter by quarter, has been decreasing. So it's one of the lowest now, like on MEV, on priority fees, we saw this year. And which may be just because that Solana got fixed in it, and then there is less leakage, as you put it. So I would say it's a mix of it, and we might see maybe more things come to light when this V3 of Ghost team, they are working on another research in it, trying to shed more light on the problem. And again, we'll be working with them to make sure that Marinade stays vigilant and stays staked to the right and good actors.
Yeah, because I've also seen people talking about there's a way to sandwich that's not like atomic, I guess. So it's not like, I don't know if that's the right term, but it's not like transaction
user transaction. It's like a longer period of time. So there's all these things that are tough to measure, right?
Like those probabilistic sandwiches.
Yes,
that's how they call it. So I'm like, I would love for this to be fixed on the protocol level, and then the Marinade stake Ocean marketplace would work the best, because by design it would leave out all those bad intentions. But I guess in these open systems, it's kind of a side feature of the system. There is MEV. There is going to be MEV. And one, you can maybe mitigate it, but you might not eliminate it. So our take is that what cannot be eliminated should be at least distributed back to users. And that's what's been happening. I think that's what is still happening with the Marinade stake auction marketplace. But at least, unlike with other ways how to stake Solana, this way users get their fair take, if you will, on MEV, be it good or bad, but at least it's distributed back to users.
Katana is an L2 built for DeFi, and it's pioneering the ecosystem category of productive TVL, believing that change should be graded on how efficiently assets are put to work in DeFi, rather than just total value locked. In just a couple months, Katana has surpassed $500 million in TVL, with over 90% of that TVL being productive in ecosystem on apps like Sushi and Morpho, which also receive boosted yields from Katana's unique Vault Bridge design. From now until the end of November, users that bridge to Katana can earn boosted yield from CAT incentive campaigns, added Vault Bridge yield, and other chain revenue. Major app launches will be coming down the pipeline in the next few months, with incentive campaigns for the Kensei Memecoin Launchpad and Perpstex partners for Katana. With the launch of Katana's chain-wide V tokenomics model, VCAT holders will be at the middle of the Katana flywheel, directing emissions and earning fees for their votes from partner protocols. Thanks, Katana, for making this episode possible. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. So, ETF season was nearly upon us. Now there's this government shutdown. I actually just saw an alert. Blockworks reported that ETF issuers have not heard from the SEC since the shutdown began, so it seems like we could be in for a bit of a wait. That's the sense I'm getting from talking to folks. But nonetheless, it bears talking about, because, as you mentioned, Marinade has sort of tried to refashion itself over the past year, 2 years or so, as more of an institutional staking provider. And you actually are the staking provider for Canary's Solana ETF. So I wanted to ask a bit about the ETF staking provider game, because this is something that's a little bit new, and it always struck me as kind of an interesting, business contest, so to speak, where there's a lot of companies trying to win over these ETF issuers who are, if these ETFs trade as well as, we think they might, will have a ton of inflows and a ton of Solana that they're going to stake with this validator. But all of the validators offer a kind of similar service. Although maybe you vary on fees and so forth. Coinbase is obviously a really big custodian, and they offer staking, so they're probably cutting deals. But I'm just curious what the jockeying looks like behind the scenes to try to be the official staking provider for some of these ETFs. Like, how are these deals actually being won and lost? What are sort of the details that the issuers go to the staking provider with, and what does the staking provider ask for from the issuer? Just show us behind the curtain a little bit there.
Yeah, I'll try. You're right. I mean, we saw, I think, back a year ago when we look at Bitcoin ETF, we saw 6% of Bitcoin supply already in ETFs. 6% of Bitcoin. We saw 3% of ETH. I think more or less it might be even bigger now with all the DATs out there. So we were thinking, look, this is going to happen to Solana at some point. We were thinking a year ago, it's going to be in 3 years, maybe. Now it's happening way faster, but it's going to happen. And when it happens, it creates this centralization risk again, which is exactly the point what we were fighting against when we started Marinade, trying to diversify to many validators and skip the biggest. So it's going to create risk. It's going to create this concern of concentration and centralization for Solana. So what do we do that year ago? What do we do right now to make sure that we can play the game and we can be a viable option? And that market segment is not does not follow yield as much as like the retail part of it. So I would call it maybe the number one thing is compliance and security for all those asset managers and ETFs. That's first. So compliance security comes first, and then yield only. You need to have a bunch of reporting set up. They are looking historically, running due diligence, trying to compare because they have fiduciary duty. So they need, at the end of the day, they should deliver the best yield to the people investing with them. So it goes, usually they go diversified, or at least they try. So the better ones try to diversify stake across multiple node operators. They enter a contract with them. At quite often, they get better deal than what's available to retail out there. So they get better commissions, share it a lot. And then it is, again, relationship game. So I'll be honest, a lot of the Solana ETF issuers are very close with the multi-chain node operators running validators on 30, 40 plus other chains than Solana. And there has been this historic agreements and relationships, and they are used to it. They are already papered with them, and they get this scale of economics because they might be partnering with them on other chains too. And Solana is just yet another chain. So we are up against quite some legacy on that front, be it the biggest exchanges running their own infra, all those big node operators already in their hands with the ETFs from Bitcoin, ETH. So what we bring to the table is that we say, look, we've been around for 34 years. We have existing relationships with all the validators out there. It's great. Even for the ETF, it's better to diversify their stake across more validators than just stick to one. And they know it. They have different criteria. Some want to be geographically diversified. Some want to stake with only SOC 2 compliant validators, which are not that many on Solana. So there are some want only their own private validator. So the very high-end institutions, they will never ever use LSTs, or even maybe not even multiple validators like Marinade, because they like to have their own private validator, and that's it. So there are a range of institutions, different ways how to go about them, but it pretty much starts with security and compliance first. And we, as Marinade, we want to make it for them super easy, not to compromise on their security standards. So we want them to stake in a safe, reliable way, like they are used to. But we want them to give a viable option to stake the right let's call it the right way, maybe on Solana, to make sure that the stake is spread across not the biggest exchange validators, but we have a way how to stake it in one click to those 20, 30 validators that are there in the ecosystem, run it well. And those are the ones that need it. Those are the ones that might die, let's say, in the next 6 months if they don't get enough stake. So without Marinade, and now being integrated with BitGo, Copper, and Zodia, and another QC on the road, those community validators would never, ever be able to get this delegation from those ETFs and ETPs. So that's where we see an opportunity for Marinade and for the Solana ecosystem overall, that we agree with those mid-small community validators, make them go through compliance, KYB checks, this node operator risk standard that we come up with on Solana, and have them truly stand up as a viable option for the institutions to consider. And we've seen some success, like with Marinade Select, which is now integrated to BitGo. We see close to 1 million Solana already staked to those 30 plus community validators. So there seems to be some initial traction in the past few weeks. We had also Bitwise using their product out of Europe, the ETP one, to use the Marinade decentralized system. So we are still hopeful, even if it's a big fight against all those big node operators and exchanges. We are hopeful that we can do something great for the ecosystem.
Do you think that like people are gonna wind up striking basically like TVL deals with between validators and issuers, where it's like, hey, I'm a validator operator, I have a bunch of SOL in my treasury, I'll seed your ETF with like 5 million in capital in exchange for you making me the validator operator, because I know that capital is then going to be staked back to me. So it's like a a lower
Yeah.
risk TVL deal, kind of?
Yeah, I'm not sure if I think still you want to be diversified. Again, you want to provide the best results out there to people investing with those products. So they just need to be reasonable. So that's why also the deals are much more aggressive. The custom deals, the bespoke deals that, we are up against when Marinade gets to be considered a staking provider for the ETFs compared to other options. It just, they all can do much more behind the scenes than the public rate. But at the same time, super, super competitive. I didn't get maybe what was the last part of the question, if you can repeat that.
I was just asking, like, do you foresee kind of functionally TVL deals happening between this is something I've thought about as this has played out.
We've seen that played out, right? That some of the big validators, well capitalized, would get to be the validator of choice for some ETF products because they would seed it. Totally. That's why it's hard for us at Marinade, being a bootstrapped company with no VC investment, to fight it. There's just no way. So how we're trying to fight it is just being transparent and provide the best rewards out there. Because at the end of the day, if you meet it on the safety, security, compliance standards, then it comes down to the number two criteria, which is the yield. And if Marinade provides better yield consistently over time to a single validator, which we feel like it is going to be, given it's a market of many different validators. So we play that card. Marinade does not run our own validator. It's only a market of many. And because it's competitive, it will always drive a higher yield. Also for the sake of diversifying, if one goes down, you won't gonna feel it because you properly diversify the portfolio. So we are hopeful that those deals will not be as often as we saw them in the past, and that we can lead with transparency and just make it very obvious that diversifying and staking with many through this auction system might yield higher yield.
How do you think about DATs? Because I feel like in some sense they offer a lot of competition. And maybe in the sense that DATs grow the pie, they're helpful. They bringing more investment into Solana, increasing the price of Sol and so forth. But they also do something else, which is that a lot of these DATs are running their own validators, staking a ton of Sol to the validator, and perhaps in the aggregate could compress Sol staking yield you get per staker. So I'd be curious, kind of, as an existing staking infrastructure provider, like how do you think about the DATs from a business perspective?
Yeah, I think it's an interesting one, right? It started with Sol strategies back then. Now we see, I think, more than 17, 18 of them on Solana. Some having 17 or 18 actually million Solana on them. So looking at, say, 5%, 4% of Solana supply, more or less, on those publicly traded companies. I think it's an interesting arbitrage on the opportunity before the ETFs are being approved. I'm so much looking forward how that's going to play out after the ETF approval. I think maybe there are too many of that, so there might be some consolidation down the road when the NAVs and everything compress. And I think that the DATs could be a bit more degen, if you will, opposed to ETFs. So we saw with some DATs that they are pretty open in participating in DeFi, right? So there can be maybe less risk averse than the ETFs. Yet I think those are interesting toolings we've seen with Upexi. They started also partially using Marinade. We recently got in touch with some on the Apex side that are about to raise up to $2 billion into their new DAT. So it's just happening out there, a lot of them. Some of them, as you say, run their own validator, their own infra. It's always a matter of, is it worth the cost of the infrastructure trying to run your own validator? And do you really make the best yield if you're only using your own node versus trying to use the market's best? So I think that's up to them. And then I'm extremely curious how that plays out once the ETFs are out there and how we're going to see the DATs and ETFs kind of playing along with each other alongside.
Do you think that drives their commissions down functionally, or I don't know. Do you have a guess of how that all plays out?
Yeah, I think so. I mean, I think that there is going to be pressure. Pretty much that's going to happen. That's what's been happening. Just pressure on the validators to keep less and less for themselves, share more and more with the end user. I think that's also why we're seeing on Solana right now that 25% of Sol is staked to private validators. So those 100% fee validators have around 100 million Sol staked on them. And some could be for compliance reasons, like we talked about, but some is just to get the best yield really on it and not be dependent on any other validator out there. So I think over time, it might compress. I think the competition is healthy. So then it only lets shine those DATs and those ETFs that kind of choose, hopefully, the highest yield option, which is where we can deliver, being Solana native and being there for a while. That's why we hope that we can win. We can help them win over the others because the yield is going to be higher. And if that happens, the stake goes to those small size validators on Solana, and hopefully everyone wins them.
What do you mean by private validators?
So those are the validators that are run at 100% fee commission. So you could pretty much spin up your own node and stake to yourself. Also, if there is any third-party stake, then that third-party stake gets zero staking rewards out of that. So all that goes to you own, and it's been pretty common practice for, say, people or institutions holding Solana grants or the individuals trying to capture the yield, because the way how you get the yield out of it is through the staking rewards, so that you would spin up 100% fee validator and pretty much capture that yield for yourself, which is separate from the underlying grant. So right now we're seeing, I think, around 100 validators on Solana out of the 1,000. And having, the last time I recall, was around 25% of Sol stake was to those private validators. So as we move on, we would love, obviously, to move as much of that stake to those validators in need and make sure that those that run the private validator only for the reason to get the best yield on it have a viable option again. So we would love to separate the delegators truly from the validators, so that the validators get stake and the stakers get the best yield without running their own infra if they don't need to.
So can you earn, do you have a sense of what the yield might be on these 100% commission validators? This is a new concept to me. This is interesting.
Yeah. So pretty much if you go right now and try to stake with 0% commission validators on Solana, you get some yield. What you don't get is the priority fees. That's the minimum you don't get, which is equivalent to, say, 30 to 50 bips right now. It's pretty compressed. Used to be 150 even. So if you have a private validator, that's pretty much what you get on top of the staking with 0% fee validator. And that's counting the priority fees. There can be other things like stake-weighted QoS, some other benefits to it. Some dApps can be using your validator stake to get transaction bandwidth priority behind their transactions. So maybe there can be more, but purely from economics perspective right now, because the validator captures the priority fees, which is equivalent to 40, 50 bips, that's what you're not getting right now as a staker. And that's what they would be getting if they stake to their own validator. At the same time, it takes $5,000 a month, more or less, to run that node for hardware costs, for voting. So you need to find the right balance between, is it really worth it for you for the hassle? But for some people and some big Solana holders, it kind of is. And that's why I think we see those private validators out there.
Because basically the logic is I have so much Solana, I could stake it all to myself and get a decent amount of block rewards from this. And then I also don't have to sacrifice my priority fees on top of that.
Yeah, exactly. You capture the priority fees, which cannot be captured by staking in a native way unless you stake with Marinade, because we did this stake auction marketplace that allows to share it back to stakers. Or you stake with LSD, to be fair. I mean, LSDs also put the priority fees back in other ways. So there are some LSDs try to share it, including MSOL, but some others that do it, to be fair. But just with native staking, there is no tooling for validators to pass on the priority fees other than Marinades. So that's why you might be tempted to run your own node.
Yeah, 25% is like a lot of stake. That's it's a bigger proportion than I would have guessed for this kind of thing. But I guess there is just a lot of SOL that's like FTX estate SOL. Like some SOL is still locked. Like there's a lot out there that's held
right,
up. Yeah.
right. Yeah, those random villagers out there with 2-3 million Solana each, and then they are just run privately. Some of them could be grants. So if you get a grant as an ecosystem project, okay, let's say there's a fire dancer coming up, so maybe the jump team could be quite well operating some of those private validators, not only also for the rewards, but just like testing fire dancer and everything.
Supposedly, too, this is a really random story, but one of the Solana co-founders is being sued by his ex-wife right now for staking her Solana to like a 100% fee validator and not telling her. So that guy too is look it up. It's a lawsuit. It's filed in the state of California. That was the only time I've heard of like a 100% fee validator, but I guess a lot of people do it. I have learned today. I wanted to touch briefly. You have the native token MNDE. I don't know how the Marinade token, I guess.
MNDE. Yeah.
And you've initiated buybacks on it, I saw, which I don't think you were doing previously. Is that like something that you think every DeFi project is going to just start doing due to the hyperliquid effect?
Yeah, that's an interesting question. And you're right, there was a governance proposal brought up by actually a community member out of our advisory board that were helping us, I think, since the very beginning. So it's this Czech family office actually that brought it up. So Philip raised it. He felt like it's a great timing for Marinade to start using it, to start doing it. So this summer, end of this summer, happened two major things. One is that all the protocol fees that flow through Marinade because of what gets captured from the validator bits, like we were talking about. Right now, that's $11-12 million annualized of revenue. So all that is routed to the DAO operational wallets, so to the Marinade Foundation. So that was one big change happening. Just 100% of the revenue accrued there. And then of that revenue, 50% is stored in on realms in the on-chain governance as MSOL, again with the MNDE holders operating that treasury. And then 50% is used on this continuous buyback program, which was announced public in its operation, how it works. So up until this point, the program, I think, has been running for 2 months and already captured more than 2 million MNDE from the protocol fees. So it seems to start to have some effect. At this point, we would be looking at between 4 to 5% of MNDE most likely bought up from the market. And I think down the road, it's a balance to tell if between appreciation or trying to do value capture for the token, because the token is at the end of the day your treasury, it is your incentives. So the stronger value for your token, the stronger the incentives, and it's like a flywheel. So you cannot neglect that. At the same time, I wouldn't start it super soon because just most of the initial fees that we're routing through Marinade, we would reinvest in more protocol building and building all the cool products that we talked about today. So there is a fine balance between what gets captured by the protocol and maybe reflected in the MND token holders versus how do you fund the next phases, next progress of Marinade. But we've seen it with other projects. I think definitely we are on a track to see this more and more often in the ecosystem. That is true.
And so it seems like in 2025, everyone needs a value accruing native token and everyone needs a stable coin. So I'm curious if launching a Marinade stablecoin is something that you've thought through. Jupiter, I think, just announced that they're launching one. So kind of got me thinking in this direction.
Yeah. No, it's a good question because when we were talking about the private validators, one way how they are used is also to get the staking rewards not in Solana, but to get it automatically transferred to stables instead. So this way you kind of hedge your the volatility of Solana price, and at the end of the year you have like predictable cash flow pretty much that is stored in stables. so in dollar value, as opposed to being exposed to Solana price fluctuating. So we saw that, and we are actually in Q4, we are about to launch a product that's called a recipe, and it's going to do just that. So you're going to stake your Solana in a native way without any smart contract risk, and you'll be able to get the staking rewards in a stablecoin. So we don't plan to launch our own stablecoin, but we plan to do quite a research on who is going to be the partner for the recipe program, as the pilot token for the recipes product is going to be a stablecoin, and it's going to be a one stablecoin issuer. So we are now doing quite a research, and you'll be able to stake your Solana to get reward in this stablecoin. So that's a tangent, but yeah, glad to mention it too.
New stablecoin sweepstakes just dropped. Send Michael an email.
Yeah.
Okay, last question for you, Michael. I think that the Solana, I saw a tweet about this, that the Solana staking space is like more interesting than you might think. And we've seen that a bit throughout this episode, but it's kind of a simple concept, but it feels like, especially over the past couple of years, there's been a lot of innovation and a lot of change. Mm-hmm. And so I'm just curious from your perspective, like, what do you think, when you think back to the very early days, when you were just trying to figure out how this even would work, get a working MVP in people's hands, versus today, how far Solana staking has come? Like, what innovations to you are the most interesting, or capture your interest the most? It can either be something that's like come out in the past couple of years, or something that is yet to come, but that kind of excites you. What's your take there?
Yeah, a good one to round it up. So I think when we look at the current rails that power the current financial system, wherever we look today and where we see the dollar signs, I think over the next few years, we are going to see crypto. So, I mean, we are bullish, we are believers in that thesis to play out eventually. And once that happens, once you revolutionize the way of we do finance on the internet, I think that we are going to have these equivalents to checking account and savings account. And what we're building at Marinade is the savings account specifically. So all the institutions, all the shops, the vendors out there are going to have an equivalent of a savings account, where I think staking is going to be playing prime there. And for me personally, what excites me is the opportunity to kind of blur the lines between, we started with liquid staking and with MSOL, with LSDs. Now we're getting to native staking, which has no smart contract risk, but it kind of sits there. It's very safe, very secure, but it sits there, cannot really be used to borrow against it or to do things that you were used to do in DeFi. So what excites me is to blur the lines between the two worlds and start thinking of these assets on your savings account as like line of credit, or you could do things on top of it. You could borrow against it. You could maybe leverage through it. You can use it as a margin account for trading. So that's what excites me for the years ahead, for the people to be safely staking their Solana, and at the same time making it very easy for them to participate in all the use cases that DeFi has yet to offer. So that's to me like the biggest thing, and it's huge, it's big enough, and we are excited about that.
Not native staking, not liquid staking, but a different third thing.
Yeah,
Michael, it's been a lot of fun having you on. Thanks for. Is this your first Lightspeed episode, by the way? I think it is.
It is.
Yeah,
it is. Yeah, thanks a lot for having me, Jack.
Long
yeah,
overdue,
it was awesome. I had a blast.
Yeah, thank you so much for taking the time.
Thank you.
Thank you, everyone. If you made it this far into the episode, we would love if you gave a like or a 5-star review, depending where you get your podcasts. If you enjoy Lightspeed, please share it with a friend, and we'll see you all again very, very soon. We'll see some of you at DAS London coming up next week. Probably, I guess by the time you hear this, it's this week. I will not be there, but I know some Marinade folks are there. Michael, are you going to be at DAS?
Yeah, I'll be there.
Michael will be there.
Yeah.
So say hello to him. Should be a great time. And that's all we have for you today. See you in the next one.